I have been investing for the past 25 years, and today I have a portfolio with stocks, ETF, funds, real estate and crypto. And thinking back about my 25-year-old self, I wish I had done a few things differently so that my portfolio today would be twice or 3 times bigger than it is. And listening to the younger people around me, I can hear and see that they are about to do the same mistakes I did when I was their age. To avoid you doing the same mistakes I did, I put together a list of 6 things I wish I had avoided when I started investing. This should give you a head start that could be worth a few $100,000 down the line. And we're gonna start with number 1, which is waiting too long to start investing. I see a lot of people getting ready to invest by researching, asking questions, reading a lot of articles, and just getting ready to being ready. They're just analyzing everything. It's literally analysis paralysis. Of course, ideally, you want to be able to invest when the market is at its lowest so you get the best upside. Problem is, you never know in advance when the market is going to dip to this lowest point. There is no way to do what's called timing the market. That's why it's so important to start investing as early as possible and as regularly as possible. Why, you may ask, is because of a law called the law of compounding interest. Even Albert Einstein called it one of the most powerful laws of the universe. Let me give you an example. Let's say you're making the median income in the US, which is about $57,000, and you decide to invest 10% of it for retirement from the age of 25 until you retire at 65 for 40 years. And let's think about a market return of about 7%. This is how much money you will end up at the end. That's a lot of money, but the green part is the compounding interest. That's how powerful that is. Now, if you started investing not when you were 25, but 35, which means 10 years later, look at how much money you will end up with. That's a big difference. And this is the power of the compounding interest. That's why you need to invest as early as possible. Now, I said investing regularly. This refers to the idea of dollar cost averaging. Every day the market goes up, the market goes down, and you never know how it goes. You should keep on investing regularly, every month, every week, every day, whichever is good for you, so that over time your the cost of your investment averages out to the mean, and you should be doing that with a tax advantageous account like a 401k or Roth IRA or NISA or iDeco in Japan or whichever it is, but more on that later. Now let's go to point number 2, which is choosing the wrong investment products. Reading the financial press, listening to experts on TV or on YouTube, it seems like you have to choose a list of 10 to 15 stocks, analyze them all the time, follow them, and then you're gonna become a millionaire. The truth is, it's really difficult to choose them, to follow recommendations, and analyzing stock is a job. And you may have already a 9-to-5 job and you don't have the time to become a professional investor. Actually, most of us will never become professional investors. That's why one of the best investors in the world, Warren Buffett, recommends index funds.
I think it's the same thing that makes most sense practically all of the time, and that is to consistently buy an S&P 500 low-cost index fund. Keep buying it through thick and thin, and especially through thin.
But what is an index fund? Actually, we just had a full video about it that I'm putting here and putting a link down below. But the actual definition of an index fund is a type of fund that just follows the broad market. So if the market goes up, and it goes up, and if the market goes down, it goes down. The index is such a large selection of individual stocks that you don't have to worry about any one stock in particular ruining your retirement plan. Index mutual funds and ETFs inside the tax advantageous account are a great way to start. Make sure they are from reputable institutions and that their cost or expense ratio is as low as possible. Nowadays, 0.5% and under is very common. We actually had a few videos centering on Japan about mutual funds and ETFs recently, so I'm putting them here on screen and also links down below for you to dive deeper. Number 3 is not caring about taxes. That's the reason why I've mentioned tax advantageous accounts so many times in the past few minutes. Taxes can significantly reduce the return of your investment, and I'm not even talking about inflation. Actually, some people say that taxes is probably your biggest life expense. I beg to differ. I think it's raising children, but that's a completely different discussion. Now, taxes and paying taxes in our society is something that's very important and that we should all be doing, at least that's my opinion, because they pay for a lot of essential services like schools, infrastructure, health and social benefit, defense and security, public services, necessary regulation, and probably some more I'm forgetting. So it's okay to pay taxes, but if you can legally reduce your tax bill, there is no reason for you not to take advantage of it. And that's why I've been talking about tax advantageous account. And there are mainly two types, the pre-tax dollar and the post-tax dollar account. Let's have a quick look. Pre-tax dollars are the likes of 401k, HSA, iDeco or DC in Japan. Basically, your contributions are deducted from your tax bill when you're doing your tax assessment. Now, there's also the post-tax dollar ones like IRA, Roth IRA, 429 or the NISA in Japan. Depending on where you live, all the dividends, all the capital gain that you have inside those accounts are tax-free, and the withdrawal are also tax-free, with some differences depending where you live and what is your age. But that would make such a big difference of how much money you're gonna receive at the end. So before thinking about a regular brokerage account, think about tax advantageous account as soon as you get started. Don't do what I did, because that was way too late when I found out that I should have used those first. Number 4 is not investing enough. If we look at the average American, she or he only invests towards retirement $5,900 a year, and in Japan it's $1,200 a year. Not exactly the maximum they are entitled to under the law for 401k or an iDeco. Now, listening to finance personalities like Sue Zerman, Dave Ramsey, or internet personality Humphrey Young, they all recommend to spend at least 50% of your annual gross income toward your retirement. Now, if we go back to our original figures of, in the US, an average salary or income of $57,000 a year, and Japan, 3.9 million yen a year, we would see that actually each represents $8,600 for the US and $3,700 for Japan. We are far from those numbers today, and there is a big gap. And this gap could be quite significant after 30 years, because these first graphs show you what an American would get after 30 years just based on how much he or she is putting aside today and how much she or he would receive if they were putting 15% of their gross income. But if you are able to save more money, say 20% or more, because you are young and have no expenses, or maybe you are making a lot of money, or maybe you are very frugal, then you're gonna go over the maximum contribution for your first retirement account, whichever you chose first. So you should then start contributing to a second tax advantageous account and try to max it out as much as possible to leverage again all those tax advantages you're getting. So whatever you're doing, please aim for the 15% gross income putting aside towards your retirement every year. Mistake number 5 is not diversifying enough, or said otherwise, putting all your eggs in the same basket. When you diversify, you spread across many different products the potential loss, but you also spread the potential gain. That's the idea of diversification. To make it very simple, I'm going to give you examples of investment portfolio that take into account the idea of diversification. And we're going to start with the simplest one, the one you've heard about, called the 60-40. That goes 60% stock, 40% bond. That's your grandpa and grandma investment portfolio. This is good if you are midlife or later in your life, to limit your risk. If you are younger and you still have a lot of time and you want to surf on the potential increase in stock, this two-fund portfolio as well. Should be 75% stock and 25% bonds. Again, it could be ETF or mutual funds. But that's not the only one. You also have what's called the three-fund portfolio. This one takes 40% stock, in this case, the total US stock, 40% international stock, so you spread your risk geographically, and 20% US bond. If you're in Japan, it's going to be 40% Japan stock, 40% international stock, and most people in Japan are going to go to the US market, and 20% Japan bonds, which would be a very bad idea because the Japanese bonds have not done so well, so it probably should be international bonds. But that's another story. And now there's another one you may have heard about. It comes from Jared Dillian, who just got this book out, this No Stress Financial Life. I'm in the middle of reading it. I'll talk about it when I'm finished. But what Jared says, he has something called the Awesome Portfolio. What's the Awesome Portfolio? Basically, it's a portfolio that tries to smooth out every possible risk. So when one asset goes down, the other asset can average it out. And how does it look like? It's divided in 5 and everything is 20%. 20% stock, 20% cash, 20% gold or commodities, 20% real estate, and 20% bonds. That's a very interesting one. But if we're talking more broadly about diversification, you should think about very different types of assets to invest your money in. For example, target date funds if you want to look at your retirement, real estate, cryptocurrencies, and commodities. Talking about cryptocurrencies and commodities, this can be very, very bumpy because there's a lot of speculation. So this should never be more than 5% of your overall portfolio to avoid losing a lot of money. But when they're upside, they're going to push your overall portfolio return up. Now let's go to mistake number 6, which is not thinking about your investment as something that evolves over time. What I want to talk about is basically your investment is not something that you set when you're 25 and stays the same until you retire. There are a lot of things that are going to influence the way you're going to invest. And the most important one is the evolution of your life. Maybe you start investing single toward your retirement, and soon you're going to think about a down payment for a house. Maybe you're going to be blessed with children, so you're going to think about paying for education. Then maybe you want to start creating some passive income because you want to create money towards retirement to replace your salary. And as we live older and older, we also need to think about long-term care because we don't want to be a burden for our children. So you have to keep all of those things in mind when you are evolving together with your investment. When you are in your 20s and 30s, you can have more risk and go all in with stocks and very little bond or fixed income. And as you're going to your 30s, 40s, 60s and 70s, you reduce drastically the amount of equities and you go toward fixed income, like we mentioned, not being a burden for your children and enjoying your retirement without worrying about money, because that's really what retirement should be about, just enjoying. Here you go, the 6 mistakes I would avoid if I were to start investing all over again. I know it was very rough and very general, but I hope it gives everyone some guidelines on what to look for on your investing journey. If you like this video, learn something, please give it a like and do not hesitate to subscribe. And if you want to know more about how to invest on the Japanese stock market with ETF and funds, you can check those 2 videos. You can click on them immediately to keep learning. Thank you for watching, and until next time, goodbye.